Welcome to Street Smart Success, the show for high net worth investors. Whether you're investing in real estate, private equity, private credit, debt, or other alternative assets, this is the show for you. This is Roger Becker, your host. Learn with me as I drill down with guests on their paths to success, what they learned, and what they're doing now. So today we have with us a fascinating man who has a very interesting perspective on the economy, domestic, local. He is a best-selling author. His most recent book is The Money Revolution, How to Finance the Next American Century. He just recently, there is bipartisan support for a sovereign wealth fund, a U.S. sovereign wealth fund. We're going to discuss that. Many other things. This is going to be a very interesting conversation, and yours truly is just going to try to hang on and follow this complex information. Today we have with us none other than Mr. Richard Duncan. Richard, welcome to Street Smart Success.
Thank you, Roger. It's very nice to meet you. Thank you for having me on.
You bet. It's an honor, a privilege, and I'm incredibly excited. Richard, before we get into what you've done most recently and what you're doing, and maybe give us a background leading up to where you are now.
Okay, well, as you mentioned at the beginning, my most recent book is called The Money Revolution, How to Finance the Next American Century. And the reason I'm so happy to have this chance to talk with you and your listeners today is that just last month, both President Biden and former President Trump announced their support for the establishment of a U.S. sovereign wealth fund. And that was exactly what my book, The Money Revolution, called for. So I believe you heard me in another podcast discussing that recently, and that was perhaps why you invited me. But your listeners are probably wondering what a U.S. sovereign wealth fund is, why it's necessary, and what it would do for them, and why in the world I came up with such an idea to begin with. And that's where my background comes in. I was born in Kentucky in 1960, made good grades in high school, and managed to get into Vanderbilt. There I studied literature and economics. Literature because I loved it, and economics because I wanted to have a job one day. And after that, I expected to go to law school, but luckily for me, I didn't get in. And plan B was to go and live in France for a year, try to find a job, just take a year off. And so I went to France with very little money and was very lucky. I found a job in Paris as a chauffeur, driving around rich American tourists. And I made enough money doing that so that I was able to keep traveling for 13 months. I traveled around Europe for about 6 months and spent a month in Egypt, a month in Israel, where I worked in a youth hostel in Jerusalem, and then 2 months in Thailand and Malaysia and Singapore in early 1984. And this was really my big break. I saw Asia was booming economically even then. These economies were growing at a double-digit rate practically. So tremendous growth, but very little competition. I would meet people in the streets who couldn't read maps of their own city. And I realized, go east, young man, this is the land of opportunity. So I went back to Europe and worked again as a chauffeur for a few more months, made some more money, and then went to business school at Babson College, where I studied finance, of course, and accounting, got an MBA. And I had some part-time jobs while I was there. I worked for Wellington Management, which is a very large fund management company in Boston. And they were kind enough, I worked in their international department, and they were kind enough to give me letters of recommendation to stockbrokers who had offices in Hong Kong. And so armed with these letters of introduction, I went to Hong Kong and was very lucky. Within 2 weeks, I landed a job, not with the big English stockbroking companies where I'd hoped to work. And there were no American companies in Hong Kong at that time, but with a local, the British wouldn't hire me because I didn't have any experience. They said, go work for a local Hong Kong Chinese stockbroking company for a little while and come back and see us in a couple of years. So that's what I did. I went to work for a local Hong Kong Chinese stockbroking company as a securities analyst, doing research on the listed Hong Kong companies, which was fascinating. And the economy was absolutely booming. The first year I was there, Hong Kong's economy, the GDP grew by 13%. And the first 12 months I was there, the Hong Kong stock market went up 100% in 12 months. The economy was just on fire. The amount of wealth on display in Hong Kong was just mind-boggling. At that time, they said high society started at 100 million US in net wealth. So since that time, I got there in 1986 when I was 25. I spent almost all of my life living outside the United States, mostly in Asia. And that's shaped the way I view the world. One important thing that came out of that is very quickly after arriving in Hong Kong, I would go across the border into China to do research on the companies. And I would see factories practically as far as the eye could see in the distance, full of 19-year-old women earning $3 a day. And it didn't take long for it to dawn on me that this was going to be extraordinarily disinflationary in the US, and that it would result in deindustrialization in the US, perhaps even with serious political ramifications. So that was the early days, really, of globalization, where the United States started running massive trade deficits for the first time. By the mid-1980s, the US current account deficit had soared to 3.5% of GDP, which was entirely unheard of. And by 2006, the current account deficit was 6% of GDP, $800 billion that year. And that's really changed the way our economy in the United States really has worked globally as well, by being so disinflationary, driving down inflation from the double digits we experienced in the early 1980s to, during most of this century, it's been 2% or less on average, up until COVID struck anyway. So after spending a couple of years in Hong Kong, the company I worked for sent me to Singapore to be the head of their research department there. And then the following year, 1989, I went back to Hong Kong and joined one of these big British stockbroking companies. It was called James Capel. And at that time, it was the biggest and the oldest UK stockbroking company. And that was a great experience. I was able to do research not only on some of the biggest listed Hong Kong companies, but also travel around the world and meet fund managers and really everywhere from Japan to London to New York and LA and around the world. And so it was fascinating to be in Asia at that time when it was booming economically. But during this period, there was one major setback for me. I was on my first big business trip to Tokyo. This was 1987 in October. I flew up first class with my boss's brother. We checked into the Imperial Hotel in Tokyo and ate Kobe beef and met fund managers in the daytime. And then on about the third day, I woke up, turned on the television, and saw some sweaty American commentator saying that Wall Street had just fallen 23% overnight. And before I put my pants on, I calculated how much money I would lose if the Hong Kong stock market went to zero. And it was a large amount, because the first 6 months I was in Hong Kong, I just waited and watched, even though the stock market was on fire. The second 6 months, I dove in head first and speculating in the most speculative things you can imagine, using leverage. And it was a disaster. When they actually shut the Hong Kong stock market for 2 weeks. And when it reopened, it fell 50%. And my portfolio of speculative things fell more like 90%. I had not only lost all the money I'd made up until that point, but quite a bit more, and was afraid I would soon be on my way back to Kentucky. But luckily, a friend lent me enough money to cover my losses, and I was able to continue working in Asia. So fast forward a couple of more years, as I mentioned, I joined this British company, James Capel. They sent me to Bangkok in 1990, and I soon became the head of their research department there. And then I became the head of the office in Bangkok in 92. Thailand's economy was growing about 10% a year. In 94, I was hired by Salomon Brothers and became their head of research for a couple of years. And in the early 90s, one thing that I didn't mention is I was also able to go to India and do research on the Indian companies when India first started opening up. In 1991, India had an economic crisis, and they got a loan and a bailout package from the IMF, and they started opening up, and they wanted the Indian companies, all the biggest Indian companies, started raising money by selling GDRs or bonds in London. And I was able to go there at the age of about 30 and meet some of the titans of Indian business. I met the Ambani brothers at Reliance, Tata family. I had tea with the chairman of Imperial Tobacco in Virginia House in Calcutta. It was just an amazing opportunity to watch India begin to open up. So all during these years, from 86 to 96, I was able to do work around Asia and see a lot of economic cycles. Asia in general was booming, but they were all on slightly different economic cycles. And it was fascinating to watch what was driving this boom. And eventually I realized it was an explosion of credit. And the reason that credit could explode is because these countries all had very large trade surpluses with the United States. And as that trade surplus money went into their banking system, it produced very rapid deposit growth. And that meant the banks had to lend out very aggressively as well. So there was very rapid loan growth. And the very rapid loan growth fueled the very rapid economic growth. But eventually this explosion of credit across Asia, it led to a credit bubble, a giant credit bubble. And by 1993, 1994, I could see that Thailand was blowing into a big economic bubble. I became quite bearish on the economy. Rather than forecasting that it would keep growing by 9% a year, as most people were, I was bearish enough to say it was going to slow down to something more like 3 or 4% growth a year, which was considered outrageous. But by that point, the stocks were trading on 100 times PE multiples in some cases. It was clearly a bubble. And then in 1997, that bubble popped in the Asia crisis. And at that time, the Thailand stock market, the GDP contracted by 10% in 1998. And the stock market fell 95% in dollar terms. But by that time, I didn't get burned because I knew it was a bubble, and I had already been burned so badly earlier on in Hong Kong, I was quite cautious. So by that point, I actually had Salomon Brothers. The things were slowing down in 96, and Salomon Brothers laid off most of its staff in Asia, including me, but with very generous severance pay. My wife and I moved to Paris for a sabbatical, and the idea was to take a year off and try to write a book. But then the Asia crisis happened, and it wasn't possible for me to go back to Asia as I had hoped to. And by that point, I didn't really want to go back to Asia. By that point, I'd done a lot of reading to try to understand what had blown Asia into a bubble to start with, a lot of economic history and classical economic text. And I've always enjoyed reading history and economic history. And I thought I really understood what was going on behind the Asia crisis. So I started calling up the IMF and the World Bank and the US Treasury Department. And I even visited them from Paris, and I harassed them until eventually I got a 3-week consulting job with the IMF. And in May of 1998, I went with a delegation from the IMF and the World Bank to Thailand for one of their consultations. They, by this point, already lent Thailand a lot of money as a part of an economic restructuring plan through IMF bailout. They'd done this for Thailand and South Korea and Indonesia, and Malaysia was also in great difficulty. So that was a very interesting experience, because by that point, I had lived in Bangkok for 6 years and had run a very large research department full of analysts doing analysis on all of the listed companies. And I had a very good idea of what was happening in in Thailand's economy as a result of that. In fact, much better than the IMF did. The IMF had just been more or less watching from afar. They didn't have an office in Thailand. And so I learned a great deal from just only 3 weeks working with the IMF in Thailand. I told them that I thought the economy, their official forecast was that Thailand's economy would contract by 3% in 1998. I wrote I thought it would be more like 10%. And if their austerity policies were pursued for much longer, it would probably be another 10% the following year. Well, it did turn out to be a contraction of 10% in 1998, but they abandoned their austerity policies and things recovered the following year. I had hoped to work for them on a full-time basis, but the IMF didn't hire me. But the World Bank did. And I joined the World Bank and worked for the World Bank in Washington for a couple of years, starting in late 1998 on issues related to the Asia crisis. And so that was also very interesting to be in Washington and get a behind-the-scenes look at how the World Bank and the IMF, the sister organization, functioned. It's quite funny. The IMF people would tell me that the IMF was like the Marines, and the World Bank was more like the Boy Scouts. That's how they viewed their relationship. And that was more or less true. So that was a great opportunity. And I learned a lot from that experience. And it was interesting because during that time, the US was blowing into a bubble, the NASDAQ bubble. And I had a chance. So having come from bubbles in Asia, I landed up in the middle of a bubble in the United States, watching a lot of very intelligent people speculating wildly in things like Cisco and pets.com. And at that point, I did a lot of research for what eventually turned into my first book, The Dollar Crisis. But as the Asia crisis wound down, the world didn't collapse into a depression, as I was afraid it would. By 2000, there wasn't really very much left to do on work related to the Asia crisis. So I went back to Hong Kong and found a job again, working as a securities analyst, this time as a banking analyst, doing research on all the banks around Asia for another British company called WI Carr. But at the end of 2001, with the NASDAQ bubble having popped and a global recession having set in, WI Carr went out of business. And so I lost that job, but got another nice big severance pay package. And with that money, I spent 2002 writing my first book, The Dollar Crisis.
In terms of the Asia financial crisis, are there things, underlying fundamentals, causes for that are occurring now in the United States, our domestic economy?
A lot has changed since then. The theme of the dollar crisis was that the large U.S. trade imbalances, the U.S. trade deficit, was destabilizing the global economy by causing the surplus countries like Japan and Taiwan, and later Thailand, Indonesia, Malaysia, and South Korea, all the surplus countries blew into bubbles, economic bubbles, as a result of all of the trade surplus money going into their banks and leading to very high rates of credit expansion and economic booms that were followed by economic bust. Surprisingly and interestingly, what I realized at the time was that what all of these countries had in common, in addition to having trade surpluses, is that their foreign exchange reserves held by their central banks skyrocketed. And the reason that happened is because, take China, for instance, which now has the largest trade surplus with the US. Chinese manufacturers sell their goods in the United States. They get paid in dollars. They take these dollars back to China. They want to convert them into the Chinese currency, the Chinese yuan. But if they did that in a free market, that would push up the Chinese exchange rate to very high levels, and that would make China's goods uncompetitive in the global economy, global market. So the central bank intervenes, and it buys all of these dollars coming into China at a fixed exchange rate in order to hold their currency down. And how do they do that? So they buy the dollars coming into China. Whoever brought the dollars in, they get to convert their dollars into the Chinese currency and do whatever they want with it. But it pretty soon all ends up on deposit in the Chinese banks and fuels very rapid loan growth. But the point here is the Central Bank of China, the People's Bank of China. At the peak, they had $4 trillion of foreign exchange reserves. So where did the Central Bank of China get $4 trillion worth of yuan to buy $4 trillion? And the answer to that is they just created it from thin air. In other words, they created their own money and used that money to buy 4 trillion US dollars. And once this is a kind of quantitative easing, Chinese style. And once they had this $4 trillion, they had to do something with it. They don't just leave these dollars in a big safe in Beijing somewhere. They have to invest these dollars in US dollar denominated assets, principally US Treasury bonds. So the bigger the US trade deficit becomes, the more dollars that throws out into the global economy. And the central banks of all of these Asian countries accumulated those dollars by creating their own money on a multi-trillion-dollar scale, and then reinvested those dollars back into US dollar denominated assets like treasury bonds and to a lesser degree stocks. But by buying treasury bonds, that pushes up the price of the treasury bonds, and that drives down the yields on the treasury bonds. And this was happening at an accelerating pace during the first 10 years of this century. And the NASDAQ bubble had popped. The economy eventually recovered. The US then started having quite rapid credit growth fueled by Fannie Mae and Freddie Mac. And by 2005, 2006, we were developing a property bubble in the United States. And at that time, Alan Greenspan started hiking the federal funds rate and trying to push up the federal funds rate, trying to push up the market-determined interest rates like treasury bond yields and mortgage yields in order to cool down the property market and cool down the economy and keep it from overheating and prevent a property bubble from happening. But that proved ineffective. They increased the federal funds rate. I can't remember off the top of my head now, but something like, 14 times by 400 or 500 basis points. But the 10-year government bond yield didn't go up between 2004 and 2006. And the reason it didn't go up is because China and other countries with large trade surpluses with the United States, their central banks had accumulated so many dollars and were accumulating so many dollars each day, each month, each year. And taking those dollars they accumulated and buying US government bonds, that it pushed up the price of the bonds and it drove down their yields. And that prevented the Fed from being able to force market-determined interest rates higher in the US in 2004, 5, and 6. So they couldn't prevent the property bubble. The property bubble ran completely out of control. And of course, that blew up in 2008. And that was essentially what my book, The Dollar Crisis, which came out in 2003 and was updated in a paperback version in 2005, that's what that book had been forecasting, that these trade imbalances were going to lead to a global economic bubble, and it was going to all end very badly with a very severe global recession and a lot of US banks and perhaps insurance companies and more all failing. And I assumed that was going to lead to a depression and the collapse of the US dollar. That was the theme of the dollar crisis. And when the dollar crisis came out, it had perfect timing in 2003. The dollar fell and fell and fell for years, and it attracted a lot of attention, and it became a bestseller, international bestseller, as my publisher describes it. I was very lucky. It was picked up by all the people who are generally bearish on the world, and one very kind man called Richard Russell, who was the grandfather of all newsletters. He published something called Dow Theory Letters. He got a copy of my book, read it, and he told his, millions perhaps of subscribers that this was a fantastic book and they all had to go out and buy it right now. And they did. And it went up to it hit the top 10 on Amazon's bestseller list for all books worldwide for a few hours. It doesn't stay there very long. We're not talking Harry Potter here in terms of book sales, but it did attract a lot of attention. And that changed the course of my career. I started making more speeches and doing more television after that. While I'd been right that these global imbalances were going to lead to a global crisis in 2008, I was wrong that it was going to lead to a global depression and to the collapse of the dollar. And the reason I was wrong is because I had never imagined such a thing as quantitative easing. When all of the banks started to fail in 2008, when Fannie and Freddie had to be taken over by the government to prevent them from failing, and when unemployment went up to 10%, the policy response was so extraordinary. On the fiscal side, the government responded with trillion-dollar budget deficits for 4 years in a row. And on the monetary side, under Ben Bernanke, the Fed printed $3.5 trillion between the end of 2008 and 2014, causing the size of their total assets to increase by 4 or 5 times during that period. Before, their total assets, representing the amount of money they had created, only amounted to less than $1 trillion. But by 2014, they peaked out at $4.5 trillion. So this was just stimulus, both fiscal and monetary, on a scale that had never occurred before. And I couldn't imagine that this would work because I assumed that so much quantitative easing, so much money creation, money printing by the Fed, everyone believed that would lead to very high rates of inflation. But in fact, it didn't. The highest inflation that we saw after 2008, the inflation rate, the CPI, moved up to 3.8% in 2011. And by early 2015, it was actually negative again. We had a couple of months of deflation in early 2015. And so this policy response was extraordinarily successful. And they got away with it without causing high rates of inflation. This forced me to re-examine all of my assumptions about what our policy options actually are. And I began to think that, all right, I was wrong. Why was I wrong? They got away with all of this extraordinary stimulus and with no inflation. Why was there no inflation? There was no inflation because of globalization. Globalization is so extraordinarily disinflationary that it allowed the US government to have trillion-dollar budget deficits and the Fed to create trillions of dollars a year of new money without causing high rates of inflation. Because once we started having trade deficits in the early 1980s, our economy was no longer constrained by domestic bottlenecks. Suddenly, rather than having just a closed US domestic economy, we had a global economy with a workforce 24 times larger than the US economy and with much greater industrial capacity, excessive industrial capacity rather than scarce industrial capacity. So this allowed the government to stimulate the US economy without fear of causing domestic overheating and inflation. And that's why the policy response to the crisis of 2008 was so successful. We didn't collapse into a new Great Depression the way we did when an earlier and smaller credit bubble popped in 1930. And the policymakers then didn't respond with massive fiscal and monetary stimulus. They just let market forces work. And market forces worked, and we had a Great Depression for 10 years, followed by a world war. This time, to prevent that, they tried a different approach of massive fiscal and monetary stimulus, and it worked amazingly well. So much better than having a new Great Depression. So given those facts, that reality, I began to wonder, well, if the US government can get away with having trillion-dollar budget deficits, and the Fed can finance these trillion-dollar budget deficits by printing money and not causing high rates of inflation, then we should take advantage of this new economic environment we find ourselves in. And I began advocating that the US government finance a very large investment in new industries and new technologies, things like over the next decade, things like making investments in new basic research and development, R&D, in things like artificial intelligence, quantum computing, genetic engineering, biotech, nanotech, robotics, and clean energy, because it would be possible for the government to finance these things very easily with the Fed creating the money and funding the government borrowing that would finance these investments in the industries of the future on a very large scale. And by investing in those sorts of industries, it would turbocharge US economic growth and induce a new technological revolution with the potential of creating extraordinary technological breakthroughs. I was talking about over the next decade, the government making this sort of investment on a multi-trillion-dollar scale over a decade, preferably in partnership with the private sector. I propose the government act more or less like a giant venture capital firm, with the government making investments in companies, private sector companies, and in startups, and funding these joint venture companies with the private sector. The government would fund them lavishly, and in exchange keep a 60% equity stake. And the private sector, the companies would be managed by America's best entrepreneurs and best scientists, and they would manage these companies and keep a 40% equity stake. And the benefit of that is that with so much funding, they would be certain to come through with extraordinary breakthroughs, things like cures for cancer, Alzheimer's, cheap fusion. These companies would become fantastically profitable, and the US government would own 60% of them. In other words, the American public would own 60% of them and share in the profits. I believe these sorts of investments would be so profitable that they would pay for themselves many times over, in addition to making the economy grow far faster than it has been growing in recent decades, and in addition to producing life-changing technological and medical breakthroughs with the potential of curing all the diseases and radically expanding life expectancy, bringing about clean energy, rejuvenating the economy, and just endless benefits. All of that seemed possible given what we saw in the aftermath of the crisis of 2008. And so I began in 2018 to write this book, my latest book, The Money Revolution, How to Finance the Next American Century. And how to finance, it's a 500-page book explaining how we got here, how our economic system changed when dollars stopped being backed by gold. Up until 1968, the Fed had to hold gold for every dollar that it issued. But by 1968, they didn't have enough gold left to issue any more dollars. So Congress changed the law and removed the requirement in 1968. Afterwards, the Fed was no longer required to hold any gold to back the money that it issued. And that radically changed the way our economic system works. Our economic system began to evolve in really quite radical ways. Before, when money was backed by gold, the US couldn't have a big trade deficit with other countries, because if it did, it would have to pay for its deficit with gold. And that would shrink the gold supply, the money supply, because it caused a severe recession in the United States. But once we no longer had to pay for our deficits with gold, we started running these enormous deficits with other countries, with a lot of countries with very low-cost labor, where workers earn 90% less than they do in the United States. This allowed the US government to have larger budget deficits, stimulating the US economy without worrying about inflation. And of course, once the Fed was no longer required to hold gold to back the dollars it created, it was essentially free to create as many dollars as it wished and finance the government's budget deficits. And so this radically altered the way our economic system worked. The Fed was no longer constrained in how much money it created. The government found it much easier to borrow on a much larger scale without driving up interest rates, because the Fed was there to buy government bonds and keep the yields low. We could run massive trade deficits with the rest of the world, creating a big global economic boom that pulled hundreds of millions of people out of poverty. And because we were buying so many things from low-cost countries, low-wage countries, we could do all of this without having high rates of inflation. So our economic system changed fundamentally when dollars ceased to be backed by gold. I describe it as capitalism evolved into what I call creditism, because creditism exploded. Total credit in the United States, which is equal to total debt, and you can think of this as all the debt of the country, not just government debt, but also household sector debt, corporate sector debt, business debt, the debt of Fannie Mae and Freddie Mac, state and local government, all the debt. It first went through $1 trillion in 1964. Last month, it went through $100 trillion. So in just 60 years, total credit in the United States has expanded 100-fold. And credit became the main driver of economic growth. Credit grew more rapidly than the economy. So the total ratio of total credit to GDP went from something like 130% of GDP in 1950 to now it's close to 360% of GDP. The credit grew much more rapidly than the economy, and as credit expanded, the American public had more money they could borrow and consume with. Businesses had more money to borrow and invest with, and asset prices surged. So our economic system changed, and this is what I wrote about in the money revolution, the history of this, and why this new economic system presents us with these opportunities for the US government to finance a multi-trillion-dollar investment in new industries and new technologies over the next decade. And this book, which I thought was going to be fantastic, new, world-changing bestseller, just about the time it was about to go to print, COVID hit in 2020. And suddenly, since I had in this book been recommending a multi-trillion-dollar investment over the next decade by the US government, suddenly the government's debt was going up at a multi-trillion-dollar rate just within a few months. In fact, in the second quarter of 2020, the debt of the United States government increased by $2.9 trillion in 3 months. And the Fed created $2.9 trillion during that same time to finance that government debt at low interest rates. So it was unclear how severe this crisis was going to be or how much debt the government would issue, how much money the Fed would create. So I had to put the book on hold. And for a year and a half, things seemed to begin stabilizing and becoming more clear by the middle of 2021. And I gave the go-ahead for it to be printed then. And it came out in February 2022, the month that Russia invaded Ukraine. So just about the time it looked like inflationary pressures were beginning to abate, Russia invades Ukraine and we get another big spike in inflation. Oil prices spike, food prices spike, energy prices spike, and we have another big round of inflation. So my whole argument had been predicated on the fact that globalization is very disinflationary and would allow us to get away with this government spending and money printing without causing high rates of inflation. Well, suddenly, before you know it, by the middle of 2022, the inflation rate, the CPI, is up to 9%. And so my book came out, unlike the dollar crisis, which had perfect timing in 2003, this book had awful timing because the inflation rate was very high. And the book didn't gain much traction. It didn't gain very much political traction. And so I was very disheartened with the timing of the book. I'd had very high hopes for this book. But time passed, and in August, a few months later, something very important happened. The US government, the Congress, passed the CHIPS and Science Act, which has the US government allocating $280 billion for investments in new industries and technologies, as I had recommended in the book, with $50 billion going to building semiconductor manufacturing facilities within the United States, and the rest going into things like R&D, technology research for quantum computing, artificial intelligence, and all of the other things I mentioned earlier. So this was great news. This was a big step in the right direction, but a big first step. But the problem was it's just not large enough because this is meant to be spread out over, 5 to 10 years. But then another positive development happened toward the end of that year. I was invited by a congressman to come to Washington and share the ideas in my book with 15 members of the House Ways and Means Committee at a policy dinner in Washington in February 2023. So I was very honored to have that opportunity to try to explain to them why the inflation that we were experiencing then would be gone before too much longer, opening up the opportunity for us again to have this chance to invest in new industries and technologies on a very large scale. So I was very grateful to have that opportunity to speak with these congressmen and congresswomen. And then time passed and inflation did drop. The CPI level peaked at 9 or 9.1%. I think last month it came in at 2.4%. The Fed's favorite measure of inflation is the PCE price index. The Fed targets 2% inflation on the PCE price index. Its most recent reading was 2.2%. So effectively, the inflation rate is now back down at the Fed's target. And so this big spike in inflation that we had, well, it resulted from a few different things in combination. But the biggest factor was that globalization suffered such a big setback with COVID. With COVID, people were locked down, not only in America, but all around the world. The Americans received very large stimulus checks from the government. They were trapped at home. All they could do is go on to Amazon and buy things like iPads and iPhones and running machines, almost all of which were made in Asia. But Asia was locked down. So demand increased sharply, supply contracted because the factories couldn't produce the goods in Asia, and that was inflationary. And then we had round after round of COVID around the world. And then, as I mentioned, Russia invaded Ukraine, creating another round. So this global supply chain bottlenecks were primarily responsible for the inflation spike that we had. And on top of that, the very large stimulus checks the government sent out increased demand, which also contributed to the high rates of inflation. But now the global supply chain bottlenecks have been worked out. The demand is still strong. The economy is still strong. The Fed increased the federal funds rate from 0 to 5.25%, trying to slow down the economy by effectively kicking people out of their jobs so that consumption would fall and the economy would slow and prices would fall. But that didn't work. The economy remains strong. The unemployment rate, I think, is 4.2% now, near historic lows. But what changed was the global supply chain bottlenecks got worked out. And globalization is once again exerting all of its deflationary forces. And so we're now back to a point where inflation is low again. And then, lo and behold, last month, almost on the same day, former President Trump and the Biden administration both came out in support of a U.S. sovereign wealth fund, which would have the U.S. government making investments in new industries and new technologies, effectively doing exactly what I recommended in my book, The Money Revolution. So this was an extremely positive development for the future of the United States. And I'm happy to have this chance to explain to your audience and anyone else who will listen why this is so urgently needed for our country and discuss the extraordinary benefits that it will produce for not only our country, but for the world.
Let me ask one clarifying question before you go into that. Very 101 question. I'm sure you explained it 10 times in the last hour, but I'm going to ask it because I'm willing to embarrass myself here. And it's real simple. Tell me again how globalization prevents inflation. Is it just because it just makes everything cost less? Oversimplification, but why does globalization prevent inflation? And how long can it continue to prevent inflation?
Yes. So in 1980, the U.S., up until 1980, U.S. trade was in balance. That meant that everything that the Americans consumed, almost everything, was made in U.S. factories with American labor, unionized labor, earning high wages with good social benefits, health insurance, and the like. Well, all of that changed when these factories started moving all of their operations to Asia. First, it was Japan and Taiwan, but then to even lower wage countries like Thailand, which I witnessed firsthand here in the early 1990s, and Malaysia and Indonesia, and a little later on, China and Vietnam and Bangladesh, and now India. And in those countries, people are willing to work for $10 a day with no benefits, even now. So maybe not in China anymore, but India's population is 1.4 billion people. I'm not sure how many manufacturing jobs there are in total in the world. Less than 100 million, probably. Let's say even 200 million. Even within India, there are probably 200 million Indians today who would accept a job paying $15 a day. So how long can it last? It can last a very long time because the global population is so large and so many people are poor. I haven't seen this statistic in the last year or two, but up until recently, there were recently as in the last few years, 2 billion people on the planet were living on less than $3 a day.
Right.
So that's why it's disinflationary.
Yeah. Okay.
And already, I mentioned the inflation rate had fallen back to 2.2% or 2.5%. The goods part of that, the goods prices are actually deflating again. The price of goods in the United States that are sold in the United States have been falling now on a year-on-year basis for more than a year. So that's a clear result of globalization, once again putting downward pressure on wages and prices and inflation. So it can last for a very long time.
And so so tell me about the Sovereign Wealth Fund and where that takes us. What is a sovereign wealth fund? How's that for you, for a question?
Right. So many countries around the world have sovereign wealth funds, and even some states in the United States, like Alaska and Texas Teachers Pension Fund, I believe, or there's some Texas school sovereign wealth fund. The one that I'm most familiar with, there are two actually, are in Singapore, Temasek and GIC. These are essentially fund management companies where the government provides the money and they are managed by investment managers who take equity stakes in companies, not only in Singapore, but all around the world. And they have used this money to develop leading companies within Singapore, on global leaders that have become extremely profitable and have paid, extraordinary dividends, made Singapore far richer than it would have been otherwise, with these benefits accruing to the Singapore public. People in Singapore have a very high standard of living. So a sovereign wealth fund essentially is the government uses government funding to make investments in private sector or companies or startups in order to help develop those industries and not only earn money, but also drive technology forward. In the case of the proposals for a U.S. sovereign wealth fund by both Trump and Biden now, they both stated that they want to invest in new industries and in new technologies, as I called for in my book. So this is fantastic. People have asked, well, why does the government need to do this through a sovereign wealth fund when the government's already making big investments in new technology? For example, in things like DARPA, which is the government invests in to advance technology. Or the government also funds a lot of research and development through its military expenditure. But what makes a sovereign wealth fund such an important step forward and so beneficial to the American public is that with a sovereign wealth fund, instead of just the government making investments and spending this money and not receiving anything directly back from that investment, by investing through a sovereign wealth fund, the government would keep equity stakes in the companies that it invests in. And as these companies become more and more profitable, then they pay for the initial investment. I believe that if this is done on a large enough scale, as I wrote in the book, that this could produce the most extraordinary technological breakthroughs. I think we should do this on a multi-trillion-dollar scale over the next decade. And that sort of investment is transformative. People say multi-trillion, that sounds like an enormous amount of money. And of course, it is a lot of money, but as I mentioned earlier, in just 3 months in 2020, the second quarter of 2020, the U.S. government borrowed, the debt of the government increased by $2.9 trillion in 90 days. And the Fed financed that by creating $2.9 trillion in 90 days. So that was a multi-trillion-dollar expansion of fiscal and monetary policy in just 3 months. That's not what I'm proposing. I'm proposing we do this over a decade. And if we were to invest on that scale over a decade, then it would induce a technological revolution. And it would make the US economy grow very much more rapidly than it has been in the last few decades. And it would be enormously beneficial to the American public because it would produce these new extraordinary technologies, cure diseases, extend life expectancy, develop fusion, cheap fusion. And these companies would be owned largely by the US government, which would finance them. So that's the difference between the way the government invests now and the way that it should invest going forward. Because in the past, the government has made a lot of investments in research and development, not as much in the past. Now, in the 1960s, the government used to invest far more relative to the size of the US economy in research and development than it does now, almost twice as much relative to the size of the GDP as it does now. So the government's been investing far too little in the last couple of decades. I think that's one of the reasons why productivity has been so slow, productivity growth. So it needs to radically reaccelerate its investment in new industries and technologies. And there are three main reasons why this is really urgently necessary for the US government to do this, why the American people need to get on board with this idea now that it has become bipartisan, supported by both sides, supported by both Democrats and Republicans. Let me start with the one that is easiest to persuade people of. We need to do this for national security reasons. China is about to overtake us, not only economically, but technologically, and therefore militarily. China's government is investing more now in new industries and new technologies than the US government is. In the year 2000, the US invested roughly 10 times as much as China does in research and development. But just in the last couple of years, China's government has overtaken the US in terms of the amount it invests in new industries and new technologies, these future industries. And that's why China had 5G 4 years before the United States does. That's why China has hypersonic missiles and the United States doesn't. That's why China is dominating the electric vehicle market globally and the electric battery market globally, and why the United States and Europe have been forced to put up large trade tariffs to keep out these much better and much cheaper Chinese cars out of our markets to protect our own industries. Well, this is just the tip of the iceberg. These are just the most visible examples. If current trends continue, within less than 10 years from now, China's investment in new industries and technologies, Chinese government investment, will be 40% more than the US government investment is every year. And if we allow that to happen, China is going to become the global superpower. They are going to, we are in a technological arms race with China. Whoever develops artificial general intelligence first is probably going to have the rest of the world at its mercy. And the Chinese government is pumping enormous, unbelievably large amounts of money into developing these new industries and technologies. They have a plan that is published that lays it all out, how they're going to dominate all of the future industries within the next 10 to 20 years. And they're right on course to doing that. They are surpassing us now as we speak. And if we don't radically change, then once China is the dominant technological power, they will be the dominant military power. And the United States will just be a vulnerable, has-been, second-rate power, essentially at China's mercy. And we cannot allow that to happen. China may be a benign ruler when it rules the world, but history suggests that countries with great technological superiority rarely treat inferior nations kindly. So we need to do this out of national security reasons. Our national security is at grave risk now. This is not a joke. China is more of a threat to the United States national security over the next decade than the Soviet Union ever was. And we had a Sputnik moment with Russia. Well, this is, we're past our Sputnik moment with China. China is on the verge of overtaking us. So that is the first reason. US private industry is great. Private sector, we've got some great, amazing private sector companies. But there is no American company that can invest on a scale that the Chinese government can invest on. The Chinese government has limitless amounts of money. No US American company has limitless amounts of money to invest. And the Chinese government is investing this limitless pool of money into becoming the global military superpower. And we're allowing them to get away with it. And so that's why sentiment has suddenly changed. That's the main reason. Now, both Democrats and Republicans have finally woken up to this fact and started doing things like the CHIPS and Science Act and now this US Sovereign Wealth Fund. That's a very good reason. But it's not the only reason that we should do this. Another reason is that our economic system is driven by credit growth. We need credit growth to expand, to keep the economy growing. If credit contracts, as it did in the 1930s, we collapse into a Great Depression. So this sort of government borrowing and investment would keep credit expanding. And the third reason is, I call it a moral imperative. We should invest on this scale in these new industries and technologies because we can so easily afford to do so. And because of the extraordinary benefits this sort of investment would produce in terms of curing diseases and developing clean, limitless, cheap fusion and rehabilitating the environment and turbocharging economic growth, radically increasing wealth in the United States. So for all three of those reasons, it is urgently necessary for us to make these sorts of investments since we can so easily afford to do this.
Richard, allow me to make a proposal as you and I hit 60 minutes. This has been unbelievable. And will you allow me to propose that you and I do a round 2 within the next couple of weeks and break this into 2 conversations and maybe even a third, but how about starting with the second?
Sure.
Let's do that. Let's end it. Perfect segue. We ended at those 3 reasons. We will recommence and continue this amazing conversation.
Great. Okay. Thank you, Roger, for allowing me to talk so much and get all of the points in that I wanted to raise.
Well, I want to hear more, so we're going to do this in another few weeks. So we'll make those arrangements. And for now, it's been great having this conversation and meeting you.